Most seniors still haven't heard about a new IRS rule that kicks in for 2026, and that silence could turn into a very expensive mistake. A major change is on the way that could put thousands of dollars back into retirees' pockets, yet hardly anyone is talking about it. This isn't a minor tweak or the usual annual inflation adjustment. It's a brand new opportunity written directly into the tax code that could sharply reduce what you owe the IRS over the next several years. Here's why it matters so much. If you're 65 or older, you may qualify for an additional tax deduction of up to $6,000 if you file as a single taxpayer, or up to $12,000 if you're married filing jointly. That's real money that could stay in your account instead of going to the government. But there is a catch. This benefit is temporary, it comes with income limits, and it's only available for a limited number of years. If you let the window close, you can't go back later to claim it. Over the next few minutes, I'm going to walk you through this step by step in clear, plain language so you understand exactly what this rule is, how it works, and whether you can use it. Because if you qualify but never claim it, you could literally be leaving thousands of dollars on the table without realizing it. Hi, I'm Timothy. If you've ever felt confused, stressed, or overwhelmed trying to make sense of taxes in retirement, you're not alone. My goal is to help seniors understand complicated financial rules and turn them into simple, practical guidance you can actually use in your everyday life. And today we're covering something that could have a very real impact on your retirement income over the next 4 years. Every year we hear about new tax changes, but most of them are small and don't really move the needle. This one is different. It was created specifically to give older Americans extra financial breathing room at a time when living costs, medical expenses, and day-to-day bills keep rising, while fixed incomes are being stretched thinner and thinner. So in this video, I'm going to explain exactly what this new IRS rule is, where it came from, how much it could potentially save you, and most importantly, what you need to do to actually claim it. By the time we're done, you'll know whether this break applies to you and how to make sure you don't miss it. And don't worry, you don't have to be a tax expert. I'll keep everything straightforward and focused on what really matters for protecting your hard-earned money in retirement. Let's start with the big picture. What changed and why is it such a big deal for seniors? The IRS has introduced a completely new, additional tax deduction targeted specifically at people age 65 and older. It's being referred to as the senior bonus deduction, and it works very differently from most tax breaks we've seen before. Usually, when a new tax benefit comes along, it replaces something else or forces you to choose between options. This one doesn't. This deduction stacks on top of what you already qualify for. You still get your regular standard deduction, you still get the extra deduction you already received for being over 65. And then, on top of both of those, you add this new senior bonus deduction. Think of it like stacking layers. Each layer sits on top of the previous one, creating a much larger overall shield that protects more of your income from federal income tax. That stacking effect is what makes this rule so powerful. This deduction was created as part of a broader effort to give financial relief to older Americans, especially those facing higher medical bills, rising housing and utility costs, and the challenge of making retirement savings last longer than ever. Lawmakers recognize that many seniors are getting squeezed, and this deduction is meant to provide direct help. Instead of sending more of your income to the IRS, this rule allows you to legally keep more of what you've already earned. And this isn't a tricky loophole or some risky scheme. It's a straightforward, legitimate deduction written directly into the tax code. But here's the key point. Just because the rule exists doesn't mean you automatically benefit from it. If you don't know about it or if you don't claim it correctly, it does absolutely nothing for you. That's why so many seniors are at risk of missing out. They simply don't realize this opportunity is sitting there. So let's talk numbers. How much money are we really talking about in everyday terms? Start with single filers who are 65 or older. Under current estimates for the 2025 tax year, the regular standard deduction for a single filer is expected to be about $1,550. On top of that, seniors already receive an additional age-based deduction of around $2,000 simply for being 65 or older. Now add the new rule an extra $6,000 senior bonus deduction on top of those amounts. Put it all together, and your total potential deduction jumps to roughly $23,750. Pause and think about that. Nearly $24,000 of your income could be completely shielded from federal income tax before you owe even a single dollar. For millions of retirees living on Social Security, small pensions, or modest withdrawals from savings, that kind of protection can make a huge difference. It gets even more significant for married couples. If both spouses are 65 or older and file a joint return, the standard deduction is projected to be about $29,200. Each spouse then gets their own senior age-based deduction for a combined additional amount of roughly $3,200. On top of that comes the new senior bonus deduction of $12,000, $6,000 for each spouse. Add all of this up, and a married couple could potentially shield about $44,400 of income from federal income tax. That's a very large amount of income to protect, especially for households trying to stretch retirement savings as far as possible. What makes this even more attractive is how easy it is to qualify. There are no special investments required. You don't need complex tax strategies. You don't have to own a home or track every expense to the penny. This benefit is available to ordinary seniors primarily based on age and income. For many people, this could be the difference between owing federal income tax and owing nothing at all. That's why understanding how it works is so important. These are not tiny, trivial savings. For a lot of retirees, they could be life-changing. Next, let's look at one of the most unusual and powerful features of this rule: its flexibility. Most tax breaks force a choice. Typically, you either take the standard deduction or you itemize your deductions: medical expenses, charitable gifts, mortgage interest, and so on. It's usually one path or the other. The senior bonus deduction breaks that pattern. It applies whether you take the standard deduction or choose to itemize. If you're someone who likes to keep things simple and just claim the standard deduction each year, you can still stack this new bonus deduction on top. If you're someone who itemizes because of high medical costs, charitable contributions, or other deductions, you can use it too. There's no penalty and no trade-off based on which route you choose. That makes this deduction much more accessible than many other tax breaks available to seniors. You don't need a complicated financial situation, and you don't need to fit into a narrow category to benefit. As long as you meet the age requirement and your income falls within the limits, the deduction is potentially available. However, there are some critical rules and limitations you absolutely need to know. This is not a permanent change, and it's not something you can claim forever. The deduction comes with a built-in expiration date. Under current law, the senior bonus deduction is only available for 4 tax years: 2025, 2026, 2027, and 2028. After that, unless Congress votes to extend it, the entire benefit disappears. That means you have a 4-year window to take advantage of this opportunity. Once that window closes, you can't go back and retroactively claim it for earlier years you missed. Many tax provisions either last for decades or become permanent, but this one has a clear, firm deadline. This is why planning ahead is so crucial. The choices you make about retirement account withdrawals, part-time wages, or other income sources over the next few years can directly influence how much you benefit from this rule. And the time limit isn't the only restriction. This deduction was designed primarily to help low and middle-income seniors. That means there are income thresholds that decide who gets the full benefit, who only gets part of it, and who doesn't qualify at all. Not everyone will receive the full $6,000 or $12,000. How much you can claim depends heavily on your income. If your income is too high, the deduction gradually shrinks and eventually disappears. Understanding those income limits is essential if you want to make the most of this opportunity. Let's walk through those limits because this is where things become a little more technical and where many people get confused. The deduction is built with what's called a phase-out. That simply means your benefit is reduced gradually as your income rises. It doesn't vanish all at once at a single dollar amount. Instead, it slowly tapers down to zero. For single filers, the full senior bonus deduction is available as long as your income is $75,000 or less. Once your income goes above $75,000, the deduction starts to shrink. By the time a single filer reaches $175,000 of income, the bonus deduction is completely gone. For married couples filing jointly, the thresholds are higher. The full benefit is available up to $150,000 of joint income. Above that amount, the deduction begins to phase out, and it disappears entirely once joint income hits $250,000. These ranges are extremely important because they determine whether you receive the full amount, a partial amount, or nothing at all. But here's the encouraging part. If your income falls inside that phase-out band, it doesn't mean you get zero. You may still be eligible for a partial deduction, and even a reduced amount can translate into meaningful savings. The reduction formula itself is fairly simple. For every $1,000 of income above the starting threshold, your senior bonus deduction is reduced by $60. So, for example, if you're a single filer with $85,000 of income, that's $10,000 above the $75,000 threshold. At $60 of reduction per $1,000 over the limit, your deduction would be reduced by $600. Instead of the full $6,000, you'd qualify for a $5,400 bonus deduction. For a married couple, suppose your joint income is $170,000. That's $20,000 above the $150,000 full benefit threshold. At $60 per $1,000, your $12,000 deduction would be reduced by $100 and $200, leaving you with $10,800 in bonus deduction. The takeaway is simple. Even if you don't qualify for the maximum benefit, you may still be entitled to a sizable tax break. Every dollar of deduction you can claim lowers your taxable income and reduces your tax bill. This is especially important for seniors close to those income thresholds. Relatively small changes in when or how you take withdrawals from retirement accounts could have a big impact on how much of this deduction you keep. A bit of planning now can pay off later, but understanding the rules is only half the job. You also need to know how to actually claim this deduction when you file your taxes. Let's talk about the practical steps. Knowing this benefit exists won't help you unless you claim it correctly at tax time. The good news is the process is more straightforward than many people fear. You don't necessarily have to hire a costly tax professional, and you don't need special credentials beyond being old enough and meeting the income rules. However, this deduction is not automatic. The IRS isn't going to add it to your return just because you turned 65. You have to claim it. First, make sure you're using the right tax form. Most seniors will want to use Form 1040-SR, which is a version of the standard Form 1040 designed specifically for older taxpayers. It has larger print and clearer formatting, making it easier to read. On Form 1040-SR, there's a checkbox to indicate that you're 65 or older. That box is crucial because it tells the IRS that you qualify for age-related tax benefits. To claim the new senior bonus deduction itself, you'll need to complete an additional form called Schedule 1A. This is where the calculation happens. The schedule walks you through determining how much of the bonus deduction you're allowed based on your filing status and income level. If you use modern tax software, the program will usually handle these calculations automatically, as long as you enter your age, filing status, and income correctly. But if you file on paper or prepare your own return, you must know which forms to use and exactly where to record the deduction. The main point is simple. This benefit only helps you if you take the time to claim it. Before we go further, we need to clear up a major misunderstanding that's already circulating. Some seniors have heard that this new deduction makes Social Security benefits completely tax-free. That is not true. Let me be very clear. The senior bonus deduction does not automatically eliminate taxes on Social Security. The rules that decide whether your Social Security is taxable have not changed. Those rules are still based on your total combined income. What this deduction does is reduce your taxable income. By lowering that number, it may indirectly reduce how much of your Social Security is subject to tax. For some retirees, especially those with modest incomes, the combination of the standard deduction, the existing senior deduction, and this new bonus deduction could result in owing little or even no federal income tax. But that depends entirely on your individual situation. This is not a magic switch that turns all of your retirement income into tax-free money. It's a powerful tool within the existing system, not a complete overhaul of the rules. Understanding that difference is critical. Making decisions based on bad or exaggerated claims can lead to unpleasant surprises at tax time. The goal is to use this new rule wisely and realistically, not to assume it wipes out every tax you might owe. Used properly, it can still provide substantial relief, even if it doesn't erase taxes for everyone. Now, let's put this into everyday terms. What does this deduction actually mean in dollars you can use? Imagine a single senior who qualifies for the full $6,000 bonus deduction and happens to fall into the 22% federal tax bracket. That $6,000 deduction could cut their tax bill by about 320s. That's not just a number on paper. That's over $1,000 that can go toward groceries, prescriptions, utilities, or other rising expenses. For married couples, the effect can be even bigger. A $12,000 deduction at the same 22% rate could mean more than $2,600 in tax savings. For retirees on fixed incomes, that kind of savings can noticeably improve day-to-day life. It might mean being able to afford better medical care, take a small trip, or simply feel less pressure when paying monthly bills. Remember, this deduction can also help if you still work part-time in retirement. Many seniors pick up extra hours to supplement Social Security or pension income. This rule can help offset some of the tax on those wages or other earnings. The core idea is that this deduction was designed to provide genuine financial help, not just move numbers around on a form. When used correctly, it can help your retirement savings stretch further at a time when every dollar matters. If you found this explanation useful so far, I'd ask you to do one simple thing. Give this video a like so more seniors can find clear, accurate information about changes that affect them. It really does help get the word out to others who might otherwise miss it. Now, let's quickly recap the key points you should remember about this new rule. You must be at least 65 years old to qualify. The deduction is available whether you're fully retired or still earning some income. You can claim it whether you take the standard deduction or itemize your deductions. There are income limits and a phase-out that determine whether you receive the full benefit, a partial amount, or nothing at all. This deduction is temporary. Under current law, it applies only for tax years 2025 through 2028, unless lawmakers extend it. Those 5 points are the foundation of everything we've discussed. Keep them in mind, and you'll already be ahead of most people in understanding how this rule works. There's one more important topic we need to cover: how to protect yourself from misinformation and scams related to this new benefit. Whenever a new tax break is announced, confusion follows, along with people trying to take advantage of it. Unfortunately, that often includes scammers and questionable companies targeting seniors who just want help. Here's a critical warning: you do not need to pay special fees to access this deduction. There is no secret program, no exclusive membership, and no insider shortcut you have to buy. All the official information is freely available from the IRS, and the forms you need are free as well. If someone contacts you claiming they can help you get this deduction faster, easier, or in some special way only they know about, be very cautious. Any honest tax preparer or even basic tax software will be able to handle this deduction once it's in place. You should never have to pay extra just to receive a benefit you're already legally entitled to. Also, beware of phone calls, emails, or online ads that try to scare you into acting immediately or paying for help. The IRS does not call people demanding instant payment or insisting you use third-party companies to claim deductions. Your safest options are to rely on official IRS resources, reputable tax software, or a trusted tax professional you already know. Staying informed and being cautious is the best way to ensure this opportunity helps you, instead of becoming another source of stress. This deduction was created to support seniors, not to create new ways for others to profit from them. With that in mind, it's worth thinking about how this 4-year window fits into your overall retirement plan. Because this benefit is temporary, the decisions you make between now and the 2028 tax year can significantly affect how much you save. If you have flexibility in how you take money from retirement accounts like IRAs or 401ks, you may want to consider how those withdrawals will affect your income relative to the phase-out limits. The same applies to part-time work, investment income, or other earnings. You don't necessarily need to overhaul your life, but being aware of the rules means you can make smarter choices. Even small adjustments like spreading withdrawals over multiple years instead of taking a large lump sum could help you stay in a range where you keep more of this deduction. The main point is this. Now that you know this rule exists, you have a chance to be proactive rather than reactive. Many seniors will never hear about it until it's too late. By paying attention now, you put yourself in a much better position to benefit. As we wrap up, let's put this opportunity in perspective. The new senior bonus deduction is one of the most significant tax breaks for retirees that we've seen in years. It can save thousands of dollars for millions of older Americans, but only for those who know it exists and take the time to use it correctly. The rules are manageable. The process to claim it is straightforward, and the potential savings are very real. But none of that matters if you ignore it or assume it's too complicated, too confusing, or too good to be true. In this case, it's a legitimate benefit, created specifically to help people just like you. The key is to stay informed, pay attention to the income limits, and be sure you actually claim it during the years it's available. Remember, the window closes after 2028 unless the law is extended, and there is no guarantee that will happen. That means the choices you make over the next few tax seasons can directly affect how much you save. Whether you file your own return, use online software, or work with a tax professional, make sure this deduction is on your radar so it doesn't slip through the cracks. Retirement should be about living your life, not constantly worrying about complex tax rules. Benefits like this are designed to give you a little extra breathing room and help your savings last longer. You've worked for decades to build some financial security. Using every legal tax break available to you is simply part of protecting what you've earned. So as you look ahead to the next few years, keep this deduction in mind. Talk it over with your spouse, your family, or your tax preparer. Review your income plans and think about how this rule might fit into your broader financial picture. A little awareness and planning today can translate into meaningful savings tomorrow. And that leads to the most important question I want you to consider. Now that you know this opportunity exists, and that it only lasts for a limited time, what steps are you going to take to make sure you benefit from it while you still can?